what could go wrong? Who cares if one company goes bankrupt, even if it's Merrill Lynch, as they did in
As it did.
2000,
Yeah.
as it did.
Yeah.
If that's one of 400 stocks in this portfolio, it's going to be like an injection. Oops! Oh, that hurt.
Yeah.
But it didn't
Yeah.
take the arm off like it would have if it was in your portfolio. So it's a difference of using the same securities, but with a safety net around it. Like right now, I'm buying equity closed-end funds. Equity closed-end funds meaning they have hundreds of different stocks inside of them. Some of them may be highly invested in the NVIDIAs and Microsofts and so on, but that's just a portion of their portfolio. And if you have many of these spread around.
Welcome to the Yacht Captain Investor Podcast. I'm your host, Scott Kidd, where every week we dive deep into conversations with real estate pros, business owners, and maritime professionals about their mindset and journey to success. Please help support us on our journey and our channel by liking, subscribing, and commenting below so we can help you in your journey to success. How you doing today? It's Scott Kidd, the Yacht Captain Investor Podcast. Today I have a new friend of mine, Steve, on here. He's a high-level business coach. Tell us a little bit about yourself, Steve, and introduce yourself.
Well, one thing, I've never been a yacht captain, although I have sailed a lot. I used to skipper a Hobie Cat, a 16-foot Hobie Cat, and race them. But that was about the extent of my captaining career.
Oh, nice.
But what I do, and what I have done for 50 years or so is manage other people's money. I did that professionally up until about 3 years ago when I sold my business. But what I did was a little bit different than your average investment advisor. I really focused on income generation instead of market value growth, although if you make enough income, your market value does grow. But that wasn't the end all and be all. We didn't pull our hair out when the market went down in 87, or most of your listeners probably don't even know about the crash of 87. But, the turn of the century, we had the dot-com bubble and stuff like that. These things didn't impact income investors. People who were focused on high-quality income-producing securities didn't suffer because they weren't chasing those dot-com type things when really tech was really coming on. That's when it all began. What's going on now started right about the turn of the century. And they had a big stumble right around that turn of the century mark, and they went down and they crashed like crazy, and everybody was pulling their hair out. But everybody who's investing in high-grade income stocks and bonds and municipals and preferreds, their portfolios just kept generating that income, So it's very similar to a real estate type enterprise where you have rental properties that are bringing income in. You've got properties that you have to sell. You have houses that you're going to sell, or you're buying and fixing and flipping, all that type of stuff. The purpose is not to build your market value. The purpose is to generate income so you can increase the amount of capital you have working for you. So you can buy another office complex or shopping center or whatever it is and have even more income coming in. You can do that in the stock market. And most advisors don't pay any attention to those possibilities, the income potential and what you can do with that without taking the types of risks that you do when you buy an IPO. It's not exciting, but it works. So that's what I do.
That's fantastic, because I always say to people that, boring is good. Boring is great, because it means it's not causing any problems.
Exactly.
But it's just taking over. Because, I always kind of wondered that, because when I was in high school, we did like a stock portfolio. It was like a limited finance, and this is in the 80s or whatever. You'd buy a certain amount of stocks or whatever, and I kind of did that. I bought stocks that that had good dividends and were kind of a higher grade. And everyone else was buying the ones that that had the big pops and everything else. And I had a couple of those, but when they would go up, I would sell those and buy more of the other ones, and I would keep doing that. And just because I figured it was supposed to be, the exercise was like you wanted to make money over, in the short term, 90 days to a year, and then long term, you wanted to build it for 10 years, 20 years, 30 years retirement or what have you. And the teacher said, well, he said, well, just do this, take your gains and buy back the blue chip stocks and just keep buying those. And over time, they pay dividends. You'll be fine. And I always thought it was simple because everyone was kind of coming up with all these strategies and stuff. And that works the same in like real estate as well. You buy for the cash flow and you use the cash flow to keep buying, more properties, and it's just, and you use, certain amount of leverage. Leverage is different from, well, it is a debt instrument, but it's not like buying stuff on the credit card. It's you using a
It's
lever
not like
to
margin. It's not like margin
margin.
debt,
Yeah.
which is totally. I think you don't do that when you're in the stock market because it's too volatile.
Yeah, too
But
volatile. Yeah.
you sound like you were way ahead of your time. I mean, if you had come to me for coaching, I would have been preaching what you just said.
Yeah, I'd probably be a millionaire. I'd probably be a billionaire by now. I probably would have had one of those funds. But no, I just listened to what the teacher said, and I thought it was a pretty simple strategy because I didn't really want to understand, or I thought I needed to understand what all these smaller companies did, which I think is the same thing like doing your due diligence in stocks and stuff like that. Same thing like with real estate. You really want to know what the property is going to do. You want to know who's operating it. Like in the stocks, you want to know who's the CEO, who are their customers.
Are there any liens against the property? All this stuff that you need to know. I mean, what is really going on in this corporation?
Yeah. How much debt do they have?
Yeah. Well, if you knew that, that I use these things called closed-end funds in my practice and in my advice, and what they are pass-through trusts. Basically, it's a managed portfolio of hundreds of securities. All the income goes to the shareholders. All but 95% goes to the shareholders. The rest is reinvested. So their emphasis is on...
What if you could buy your first investment property in just 30 days? With a proven playbook built by a pro with 25 years in the game, it's not just possible, it's a plan. Scott Kidd's complete bundle gives you everything you need. 7 professional tools, delivered instantly. No fluff, no guesswork. Just the exact roadmap to your first property. From Yacht Captain to Managing Director of Capital Markets, Scott Kidd has navigated deals most investors only dream about. Now he's handing you his full playbook. If you're a high earner who keeps researching but never pulling the trigger, if you feel overwhelmed by the process, this was built specifically for you. Virtual walkthrough guide and the napkin deal calculator. Inside, the 30-day checklist property locator playbook. By box builder, market scorecard, agent vetting script. And right now, free bonus access to all tools, including the Portfolio Investor Clarity tool. Visit investwithscottkidd.com and get the bundle today. Your first property starts now.
Is on making money and passing it through. So the average yield on these things is right now around 9 and 10%, which is way up there. And you have these portfolios that have been managed professionally, but they've been around for long periods of time, hundreds of securities involved, and they generate this kind of income. What could go wrong? Who cares if one company goes bankrupt, even if it's Merrill Lynch, as they did in 2000, as it did.
Yeah.
If that's one of 400 stocks in this portfolio, it's going to be like an injection. Oops! Oh, that hurt.
Yeah.
But it didn't take the arm off like it would have if it was in your portfolio. So it's a difference of using the same securities but with a safety net around it. Like right
Mm-hmm.
now, I'm buying equity closed-end funds. Equity closed-end funds meaning they have hundreds of different stocks inside of them. Some of them may be highly invested in the Nvidias and Microsofts and so on, but that's just a portion of their portfolio. And if you have many of these spread around, what happens in the stock market can only pretty much benefit you because their job is to send you money. Nvidia's job is pretty much to make the owners wealthy in terms of
Yeah.
market value, but they don't pay any dividends. They're
Mm-hmm.
worth billions, but not $1 in profit has ever been given to a shareholder, only to the
Mm.
executives, only to the owners.
Yeah.
Whereas in these funds that I use, and they make money, and they sell Nvidia, and then they buy it back again, and keep doing that every time it goes up and down. That profit comes right to me in the
Mm-hmm.
form of distributions, and
Oh,
that
nice.
makes me feel a lot safer. So I don't care when I see the market go down. I say, "Oh man, good! My managers can now buy these companies cheaper."
Mm-hmm.
And then it goes up again. They sell them, and I make money. And I do the
Yeah,
same thing.
that's
And I do the same thing with the closed-end funds because they
nice.
trade like stocks. So uh, just think about real estate, and let's think about real estate. Let's think about liquidity in general.
Mm-hmm.
You can't go buy a house and sell it.
No,
There's
not
stuff
yet.
involved. It's not liquid. You've got paperwork. You got attorneys. You got the signees. All these papers.
Yeah.
I mean, I don't think the paperwork could be done overnight. You know what I mean?
No, there's where commercial and residential and real estate
Right.
is, decades behind because I never saw a reason why, you're buying it like anything else, but you have, so many different agencies, so many different, I
Sure.
think somebody told me there's like 31 different entities involved in just buying a house I don't
Oh,
know if that's accurate or anything, but
I don't know if it is, but
I'm not
I know.
I'm not a real estate agent or advisor
Right.
or financial guy, but it just like a, financial advisor by any means. But it doesn't make any sense why, because you're buying pieces of these companies in the stock trading platforms. There's some of these companies are very, very complicated. Why can't you just buy and sell a piece of a house or a real estate just like that?
I know.
I see certain platforms are coming out like that. There's no reason. I think it's remained illiquid for a reason to kind of keep more of the control elsewhere rather than
Maybe.
the average
But
public. That's just me.
but closed-end funds are a solution for that because
Mm-hmm.
I can buy and sell real estate the same day. I can buy a fund that owns real estate companies or real estate properties um, or REITs and things like that, and I can trade them
Mm-hmm.
in these portfolios. But think about stuff like corporate and municipal bonds. They have the same liquidity issues. You
Mm-hmm.
can't go on the New York Stock Exchange and say, "Oh, I got this bond from Citibank and it's paying 4%, and I've got it here. I want to sell it." Well, we've got to get a bid, and we got to get it. We got to see what it's worth. We got to get a bid price on it, and
Mm-hmm.
and see. And then there's a markup we have to take, and there's this,
Yeah.
and we got to find a buyer for it. We can't
Yeah.
just
Yeah.
they're not out there. Well, in a closed-end fund, this thing contains hundreds of bonds, corporate, municipal, and all you have to do is push a button, say, "I'm going to buy those bonds right now." Bingo, and I bought them. I bought a portfolio of 300 or 400 municipal bonds with the touch of my finger for $14 a share, and it's yielding 6.5% tax free. I can do that
Nice.
with these closed-end funds. You see what I'm saying? So I found this vehicle, and this vehicle isn't a new vehicle. This vehicle's been around since the early
Yeah.
1800s. Before municipal bonds existed, closed-end funds existed. But Wall Street, for some reason, is afraid of municipal bonds. They don't
Well, I
like
think
them.
it's probably because they can't control the fees so much.
Well, the fees are high, but
Fees are
when
high.
I
Okay.
but But when I get 7%, that's net of fees. That's after expenses. And that's on a tax-free municipal bond. On my equities, I'm getting 9% after expenses. And I don't have to pay the manager. They're paying the manager.
That's post manager. That's net of all expenses. Okay.
Right. And it's net of all the leverage expense. So these guys, when they sell these things, they then go out and borrow money, but not a margin loan, just like a collateralized loan, like you have,
Mm-hmm.
like I have on my security portfolio, because I didn't want to pay this after I sold my business. I didn't want to pay that whole lump, couple $100,000 of taxes in one lump sum, so I borrowed it at 6% against my portfolio.
So you borrowed against it and
a collateralized loan to pay off the taxes, and I pay it back little by little. Because the money I'm investing is yielding 10%. That's without any capital gains, and I'm paying 6%. So it's just like when you buy.
Get the margin, you get
the income is pure profit.
The delta. Yeah, you get the delta.
Just like you run a real estate thing.
Yeah.
You can't. You don't go out and buy a house with cash or another building, an apartment. No, you borrow the money because your return, your dollars are going to be more than pay the cost.
Yeah.
So that's
especially when you're building wealth. Especially when you're building wealth, you use leverage, the right amount of leverage, and the right type of leverage.
Right. So back to the original thing. The stock market is closed-end funds that I use. The average leverage they use is around 30%. Do you know what the average on the stock exchange is of normal companies? The average debt-to-equity ratio? It's more like 80%. The average.
80%.
60, 70, 80%. Double what these.
Are you investing blind? Most passive investors don't know what questions to ask, and it costs them dearly. That's why I put together 125 essential questions. The ultimate due diligence checklist for apartments, syndications, and funds. Cover every critical area. The operator's track record, the loan structure and refinancing risk, property condition and capital needs, market demographics and competition. Ask things like, how many assets have gone through a full cycle? What is the loan-to-value ratio? What is the break-even occupancy? This is the checklist sophisticated investors use, and now it's yours free. Get instant access at investwithscottkid.com interactive. Trackable, exportable to PDF. Protect your capital. Invest with confidence.
Closed-end funds are. And that's one of the arguments that a lot of advisors use against CEFs. Oh, they borrow money. Well, so does every company you buy.
Yes, any company that's looking to grow is borrowing money. Any real estate company is borrowing money. It's using other people's money. It's one of those things where people get a little misguided when it comes to the difference between debt and leverage. Like Archimedes said, give him the right amount of leverage and he can lift the universe or whatever it is, or something like that. But because if you use the right amount and the right type, you're definitely optimized for whatever you're doing. And the average right now in commercial real estate is probably about 65 to 70%. Yeah. Some of them are even going less, 60%, even less.
Here's a question for you. This is right up your alley. I'm closing on my new house in Amelia on the 13th. Okay? And I've got all the work done for the mortgage and everything like that and what I have to pay. My house is on the market, but I don't have a buyer yet. And I've got less than a month. Okay? All right. So, and I have very little loan on my house now. So but I have to come up with the down payment for the Amelia property. And I don't want to have two properties. I don't want to have two mortgages going at the same time. Okay?
Yeah.
So if I don't get a buyer within the next week or two, I'll never close before and have the money available to, at the time. I'm not going to have the money. I'm not going to have the new money available at the time I closed on the first one. So I know I'm going to have to do a loan to get the down payment to that.
Yeah, to do like some kind of collateralize some of your other
I'll,
assets or something like
I
that.
will. I'll use the same collateralized loan because it's not even 20% of the asset.
Yeah. Do you have like
It's on one of my investment portfolios. It's only about 20% of it
okay.
now. So I can
You
go
have
to, I have $1 million
home
line of
equity?
credit. Hmm?
Okay. Oh, you have $1 million line of credit. Okay. So then you
Yeah. So
can,
that I can use. Yeah. And the rate's not bad. But with my existing house that I'm living in, should I move immediately and leave it vacant and go there
uh,
and let the realtor handle it here? Should I say, well, maybe we could do a rent of some kind?
yeah, you
What,
could
what
probably
do you
rent
see
it
going
for a while.
on?
In Charleston, I know the market
It's on
is pretty
Kiowa
good.
Island. It's near Kiowak Resort, and it's on a golf course. And summer
Oh,
is there.
is that up by the beach there across the bridge near Ashley? Close to Ashley?
West Ashley, you mean? It's,
Yeah, West Ashley, yeah.
it's
Is
near
that
West.
over
It's over
West
by
Ashley?
Kiowa Island. Is the golf resort. There's Seabrook Island and Kiowa Island out
Is
there.
that close? Is that north of the inlet there? North of the inlet?
This is the inlet.
North of the Charleston Harbor. Like
I'd say it's almost due west or a little southwest. It's
okay.
west of Folly Beach. Folly Beach is right below it.
Oh, okay, okay. Okay, Folly Beach is on the southern end. Okay.
Yes.
All
Yeah.
right.
So
Yeah, I would say you wouldn't have a problem. You may not have a problem renting it.
renting that, right? Should I leave it? Should I leave the basic furnishings and
I don't
just
know.
go?
It would just depend, if that's your personal taste or whatever. But you could be doing. Is it seasonal right now? Is it in season?
Well, it's good season for golf right now, but once it warms up, you don't get as many golfers, but you get a lot of people
Families and
who want to
stuff.
golf while their families go to the beach. That's what you get.
Yeah, I would say maybe speak to an agent that does some kind of. Are there any restrictions on you doing
Of
short to
renting of
midterm
renting to
rental?
have? No, I bought this one. It was being rented when I bought it in the first place.
Okay, and I mean like short term rentals. Sometimes they have restrictions and
Yeah,
stuff like that.
they may have that. I'll have to check. I'll check with my
Yeah,
realtor about that.
there is also, and I'll send you the link when we get finished here. It's a friend of mine. She started a platform for midterm rentals, and they cater to a lot of like insurance displacements. Like say there's a disaster, somebody's house gets on fire, or flooding or what have you. Because insurance companies pay a premium for displaced families and stuff, and because they'd rather pay for a house rather than three or four
Rental.
hotels and food and
Yeah,
everything
they.
else. And yeah, and she's found
It's
a really great niche there. She has several houses in Ohio and probably down in Florida now too, where you she said she's never nervous about it not being rented. She said it's maybe in the years that she's been doing it, maybe 1 or 2 weeks a year. It's not
maybe
because
I'll talk.
I'll
I'll
send it
talk.
to you.
Yeah, because I
I
have.
think yeah, I think it'd probably be good to speak to a local someone that manages property in the area, see what
I'll
their
see. She
sentiment
probably
is.
knows.
That'd probably be better than the agent because they're going to tell you, yeah, oh yeah, do that, and I'll rent it out for you, and could
Well,
be 6 months. And
she's
oh, okay.
fortunately she's a family friend at the agent,
Well, that's good then.
so I trust her, and she probably knows the answers. But I
Yeah.
just have to start doing some planning for that contingency, that turnover
Yeah, because you're
period.
going to have a little bit of a gap. You're going to have a little bit of a gap there.
Yeah,
And sometimes that's how it goes. It takes a little while, and if it's
yeah.
renting and it's making cash flow and paying for the mortgage or
It's
whatever,
paid
then
itself.
it's not so much of a sting, when you're
Right.
covering two mortgages.
And then the granddaughter's going to law school starting this August. So that
Oh,
expense
yeah.
on top of this expense,
Yeah. I have two kids in college right now, so it's
You know what I'm
it's one of
talking
those
about.
things where we they get to be on their own, and it adds up. But I'm glad that we're in a position where we can provide for them
We
to
can
to be
talk
able to
both
get
talk.
to the
We're
next
both
level.
talking about it, and we're both still smiling. So that's okay. That's good.
Yeah.
It means we can
Yeah.
afford. But circling back to what I do and what I teach and what my book is all about. Can you see my book over there? Retirement Money Secrets. Let me turn my
No, but
camera.
we'll put that in. We'll put
There,
that in the
there it
show notes.
is.
Oh, there
There
you
it is.
go. All right.
Anyway,
We'll
but getting
definitely
back
send
to
that
what
to me,
that
and we'll put
does
that in the show notes. Yeah.
is that in my position and in your position, this type of life.
Most investors don't know where they stand. Introducing Invest with Scott Kidd. Get your personalized investment readiness score. Multifamily real estate builds wealth through cash flow. You'll receive your readiness score, a personalized strategy. Join over 500 investors. Discover if you're ready. Start your free assessment today.
Contingency. This is a real thing that's going on in my life right now. The granddaughter and the two houses going on. I'm not losing any sleep over this because my income from my investments, not from my business, not from my coaching, from my investment portfolio, can cover it.
Yeah.
And that's where you want to be.
Yeah.
That's where people need to be. And they can
Yeah.
get there, but they have to change the mindset. They can't
Hmm.
say, got to get that market value up, got to get that market value up. What you got to
Yeah.
do is you got to hammer your advisor and say, I don't really care about that market value. I want you to grow my income so that when I need it, I can spend it. I've got it. It's coming in. If we choose to reinvest it and reinvest it and reinvest it, that's fine. But when I tell you that 4 months from now, I'm going to need X amount of money, I don't want you saying, oh, hem and hawing, well, the market's down. We're going to have to sell something.
Yeah.
I want to know that that income is coming in every month, and all you got to do is just not reinvest it, and it'll be there when I need it. That's what I teach people how to do.
Well,
That's
that's
what I
really
teach people.
great because it takes a different mindset, and then it takes discipline to just keep putting away a certain amount and keep generating that income, and then people, you have to. The hardest lesson for a lot of people, myself included, is that lifestyle creep, and then the living beyond your means. You get wrapped up in a lot of the things that are going on everywhere. But if you figure out what's important and make those choices based on that, then it makes life a lot more simple.
Sure, right. Even if you're not in either of our businesses, you're just in a plain old career, a plain old practice. You're a doctor, you're a lawyer, you're whatever
Yeah.
you are, and and knowing, like you said, living beyond your means, you're making a whole lot of money,
Hmm.
but you're not creating that other stream of income, the income that's going to take care of you when you want to take a sabbatical for a year. You want to,
Hmm.
you want to go around the world once or twice while you're in your 50s instead of waiting until you're in your 70s. You know,
Yeah.
so you need money to do that. You need cash flow. You need income, and you can do that with your investment portfolio if you instruct your advisor to make you income, to generate income, and not chase market value. The only reason in today's environment why this is so difficult is because of a thing that happened about 20 years ago or so when they stopped when actually Charles Schwab came on and offered people the ability to trade stocks with pretty much zero commissions.
Hmm.
And all of a sudden, all the big guys had to say, oh my God, he's taking all our clients because we charge commissions.
Mm-hmm.
So they, instead of charging commissions anymore, decided they would charge based on the amount under management, the AUM,
Mm-hmm.
assets under management, a percentage. So what did that change in the financial services environment? Their goal as an advisor is, I'm not going to put people in bonds or preferred stocks, stuff like, or REITs, because they don't go up and they don't spike. They don't create great jumps in AUM. They just produce income. They're boring. They're no good. I have to put them in things that will climb and will grow. I have to make them reinvest, drip all their income so that they keep buying more and more and more of the same stuff, because that'll go up in market value. I can't let them take any money out. I'm going to
Yeah.
just grow, because that's how I get paid. I don't get
Yeah.
paid on giving them money to spend.
Yeah.
Now,
Yeah.
that changed. Before, if somebody bought a bond, that was a big commission. That was a bigger commission than buying stocks, because it was a markup involved. It was a
Mm.
markup commission. When they sold stocks, they got commissions on the buy and they got a commission on the sell. So
Mm.
they were making money for the client, but they were making money too. And that all changed. It all changed. As soon as Schwab began the free ride of trading on the internet, the financial community had to go to a fee-based environment, and all this BS about fiduciary responsibility. It used to
Yeah.
be
It's
true.
gone.
It used to be true. No advisor would sell you a junk bond, because they
No.
didn't have to, because there was good quality stuff to sell. But now they'll sell you anything, because all they care about is the AUM. They don't care about the
That's a
income.
great point.
I mean, you have people, I've seen portfolios of people who are 65 or older and retired. They don't have, their portfolios are making less than 2%. And their genius of an advisor saying, well, we're going to take out 4% every year because that's what you need to live on. Well, why can't you? My friend, why can't you make me 5% per
Yeah.
year? So
5%.
not
Yeah.
only does it pay your fee, and it pays me what I need. Why are you only making me 1% when
Yeah.
when I have to take out 4%? There's
Yeah.
no real answer for that, other than, well, because I got to get paid on AUM and I need more money.
Yeah. And
So
the
that's the
assets
difference.
under management. Yeah, that's a
That's
big deal, because the assets under management, you see the reason why it breeds that mentality where they get 1, 2, 3% on the back end, whatever their front end and back end fees are. They can be quite extensive, and they get
it's
paid
usually
up front.
about one and
Yeah.
a half. They get paid
1.5.
on a management for investment management. I used to manage portfolios for about 1.2% on
Yeah.
average. The bigger the account was, the lower the fee was.
Yeah.
But
Yeah.
still,
That's usually how it goes. And there's a reason why also, like, a lot of financial advisors are push the stocks, because they want to get more assets under management. And anytime when I'm speaking to somebody about real estate and they're looking at, partnering with us or what have you, when they say, well, let me speak to my financial advisor, it's usually a hard no, because they don't want you taking any money out of the fund,
that's right.
out of their retirement or whatever. When you show them, look, just on paper, if you went into a debt instrument or real estate, or some kind of equity position in real estate, you'll beat those returns a lot of times if
Well,
if you're in with
you'll
the
have,
right people. If you're in the right people,
the difference is you'll have realized returns.
yeah,
Returns you can actually spend. The only returns you get in the stock market are unrealized returns,
yeah,
because they will never sell anything that's up.
no,
There's two reasons. One, they're making more money this way. But the second reason is a practical one, and it's a problem that's tough to resolve. And that's the legal problem, is that, let's say you owned let's say I was your advisor and you owned Microsoft and you were up 50%. And I said, Scott, you got to sell to Microsoft. You got all this profit. Let's diversify a little bit, right? And you agree, and I go and do that. Well, at Microsoft probably doubled since then. And sometimes you're saying, I get a phone from headquarters that I'm being sued by Scott because you sold his Microsoft and it went up in price, and now he's saying we owe him all this money. I said, yeah, but I reinvested in all this stuff and it's gone up too, and it's paid all this. Doesn't matter. Microsoft is the subject, and you schmuck, you sold it. You should never have sold it. You know, so
Yeah.
so brokers are reluctant to suggest to you to take profits.
Wow.
If you
So
tell
that's
them,
interesting.
if you tell them, please, and they'll expect it in writing from you. Please sell my Microsoft. I want to take the profits. Oh my goodness!
Yeah, that's
I don't know what that's all about. Anyway,
yeah, that's the thing. That's a good point, because it kind of de-incentivizes them to give you any advice, because because they're afraid of getting sued
they're
or
afraid of getting
selling at
sued.
the wrong time
So
or whatever. You know?
and so it actually operates. They can't really be a fiduciary if being a fiduciary in that situation would possibly get them in legal trouble, because you had all this money in one thing, you were poorly diversified, which is dangerous. Everybody would agree to that, and you have no idea how to predict the future, but everybody expects, well, you must know the future if you're telling me what to do, so it's a tough business to be in. It really is.
It really is, and it's
I had an advisory agreement that I'd get clients would have to sign. And I said, I have a target. This was in the stock market. I have a target of 10% profit. If anything gets even close to 10%, I'm taking the profit. And you're signing right here to say, Steve, that's okay. I understand. If you don't, I'm not going to manage money for you. Because then you're going to sue me because Microsoft went up and then it went back down again and you didn't sell it. You let me lose my profit. So either way, I'm going to get sued if I don't make you understand that this is how we're managing.
Yeah, I've always had a different mentality, I guess, a little bit, like, because when 2007, 8, I had someone that was a financial, I think they might have been a CPA or something like that, and they told me, wow, your retirement really dropped out. We should sell it and put it into something 4% or whatever. And I'm like, no, now is the time, since everything's down. We look at where the value is. We buy. Like I did that during COVID, and I saw Exxon was was as low as it was in the 80s, and I said, well, I should buy as much of that as I can, and I still have it because it's paying a dividend.
Do you remember the Exxon Valdez? You remember that? The same thing. The price plummeted. I bought it for most of my clients. Went up, I sold it.
Mm-hmm.
So that's. But you're thinking, and I think it's, for a lot to do with your involvement in real estate. I think that's where I got it from, frankly, because of my dad. But that type of thinking is the way you make money. The thinking, the buy and hold mentality. The core portfolio, buy and hold, all of that stuff. Eventually, it's going to hurt you, particularly if the market, what if you had just retired in 2007? Just retired in 2007, and all of a sudden, your 4% that you're taking out kept coming out with a smaller number, and you go down and down and down. They call that sequence of returns risk.
Well, and that's why I guess they always recommended. I remember this from a friend of mine telling me that you buy a lot of equities and stuff for a long time, and then most of your career, and then your late 50s and stuff, you start changing it into stuff that's more stable, bonds or whatever. You're less, you're more liquid, I guess, stuff that's fixed income stuff.
you're less
Yeah.
you're not more liquid necessarily, but you certainly have less at risk
Yeah.
financially. If you
Yeah.
understand that when the bond goes down because interest rates go up, it's not a bad thing. It's still
Yeah.
paying the same amount of money, and you don't get
Yeah.
those guys who tell you at the end of the year, "Oh, well, now is the time to sell all your bonds that are down, and we'll buy you new bonds, and then you can use the losses to offset."
It's actually the opposite. It's actually the opposite way,
Yeah, you should
because
be buying those, not selling them, right?
yeah,
So
because then you're getting the high interest at the low price.
exactly,
So
but they
that's where it's actually good.
there are those fiduciaries again, helping you pay less in taxes by
Mm,
destroying your capital base.
yeah.
See,
Yeah,
so
it's a hard line, with a lot of people, they in real estate, they think they should just buy stuff just to offset their taxes and stuff. Well, you shouldn't really buy anything to offset any of your taxes. You should buy for the cash flow, buy
exactly.
for the long-term gain. And if you can take that tax and apply it and spread it out,
I,
then you're going to be good over the long term, and keep doing that strategy. It's boring, but, it
boring is good.
works. People have been
Boring
doing
is
it for hundreds of years.
yeah. I
It's a
said
proven strategy.
I guess there are two comments I made in my previous book, and I don't know if they went over into secrets or not. But in one instance, when you say, "Well, I don't need any more money," or "I don't want money," I said saying that is the same thing as going into your boss's office and say, "No, no, no. I don't want that $300,000 bonus because it'll put me into a higher tax bracket. Keep it. I
Yeah,
don't want it." That's one thing. And the other thing is when your accountant tells you or your advisor tells you to take losses to offset your taxes, you won't pay as much in taxes. And you say to him, based on that logic, I'm not going to pay you your fee because then you won't have to pay as many taxes. How do you like that? Does
yeah,
that work?
yeah.
It's the
I
same type of thinking. That
yeah,
you,
I always said to people, when people looked at me like I was crazy, I said my goal is to pay $1 million in taxes.
taxes, my goal is to pay $1 million.
Because if I'm paying a million,
I mean,
if I'm paying a million in Social Security and Medicare and whatever else, I'm
you've made three
probably
million,
making 20 million or 100.
3 million probably,
Well,
30%.
it depends. If you
I
got into
know.
real estate, you're
Yeah,
deferring
real
it.
estate. Real estate, you have a lot of legal ways
Yeah,
to do
tax
that.
advantages. People, I get a little bit frustrated when people say it's loopholes and stuff. It's actually rules that are in there. It's the
It's
same rules
rules,
that
yeah,
everybody can use.
and
It's not a loophole.
it helps keep the value of real estate where it
Yeah.
is.
And it also incentivizes, all these rules are set up to incentivize people to build more, create opportunities, revitalize areas and stuff. And, people take advantage one way or the other, but, the big part of the whole strategy is to be able to use that offset to where you can get that gain and roll it into more and more properties and keep building to where people use it to revitalize areas. People use it to build more. Hey, we have a shortage of housing and stuff, and we have a shortage of medical offices and all these other assets and stuff that need to be like an office that need to be repurposed. So of course they're going to put some incentives in there so that people can repurpose those buildings or just completely tear them down and do something else with it that's a better use for everyone around there. And that's something that people don't understand. They always think it's the rich, wealthy landlord. Well, they have to pay their bills too. We all have to pay. It costs a lot of money to carry that. That's a whole business where it has a lot of overhead. You know.
It does. That's the main difference between our our two focuses. The
Yeah.
investing has a much less overhead.
Yes.
than real estate does.
Yeah, and your whole mantra is really passive. You know, you're getting that passive income because you're really finding these closed-end funds and everything else that produce X amount of return when you put it in and you
Right.
buy it right, you get that return. Whereas a lot of real estate is they say it's passive, but it's a lie.
Yeah, I
It's
mean, it's
active.
passive. It's active. You gotta get the plumber over that building, man.
Yeah, yeah.
You know what I mean? There's things to
Unless
do.
you're investing into like a REIT or a real estate fund,
Right.
or you're investing in a syndication or something, you're really not passive, you know. And really, you when you're investing with someone, because you're investing with the sponsor or the fund manager, you really should be active in who you're investing with, because it's really about the sponsor and the fund manager, because you're relying on them.
And they're
If they, it's not a matter of if things go bad. It's when things go bad, things take a turn. What is this person going to do?
yeah.
You know, are they going to not answer your calls? Are they going to say, hey John, hey John, we're in a rough spot right now. We've recapitalized. We've brought in some of our own money. We're working to get through. It's going to be probably 6 months to a year where we're going to ride this through, but we're right here with you. We're going to keep you in the loop. You know, that's the person you want with you. You know, because if they have skin in the game, they're going to do everything they can to get that deal keep going. But you know, like you're saying with the fiduciary responsibility of the fund managers, or the, you know, your retirement plan person, they really don't have any skin in the game in your fund, other than assets under management and the 1% or 2%.
What I used to do, speaking like you are and yours, I used to handle that. And what I used to tell my clients, and what I tell my members of my community now, when I give them, I produce these universes, so what the selection universes to choose from, I tell them, and I told my clients then, I will never, ever invest any of your money in something that I don't own personally.
Mm-hmm.
I own every security that I have in those universes that I put into the community that people should use to select from in making their investment choices, because I don't do it for them anymore.
Really
You know,
cool.
so that, and the third thing I used to tell them was this. The third thing was tell that I will make for you every year. I will make for you in profits more than you pay me in fees. That's
Perfect.
how I handled being an advisor.
Yeah. No, that's great. Well, this has been a really great conversation. And I look forward to having you on again at some point, because this has been. I've learned a lot. Like I said, I'm not an advisor. I don't give advice to anyone. This is all just for educational purposes. But I know you have that background, and you can speak to these topics. So it's really great to be able to speak to you. So thank you so much.
You're welcome. I've enjoyed it. I always get a kick out of the parallels between the real estate environment and which everybody agrees, real estate is a safe form of investing.
Yeah.
And I kind of hope that I've made the stock market and bond market investing feel as safe and comfortable as you all make the real estate environment feel.
Well,
And
I don't know too much about closed end funds. I know what they look like on the real estate side, but I'm definitely going to do some investigation about this, because I think that's a great, it's always good to have other tools in your tool belt for, long term gains and stuff.
right,
But
it can't
for
hurt
people
to
that
have
want to,
another stream of income, right?
no, it never can. And for people that want to find out more about your book and about what you're doing in your coaching program, what's the best way for them to find you?
Well, the book is right here, and that's on Amazon or any place else they would get books. Um, my website is theincomecoach.net, and
Okay,
it and
that's easy.
that's easy. And it explains everything. It talks about the book. It explains about the community that we have to discuss income investing and what my coaching things are. I even have a course. They don't want to get involved with other people. They can take a course in income investing. So it's
Nice.
all
Really
on
cool.
theincomecoach.net.
Well, this has been really great. I really appreciate you coming on, and I look forward to other conversations about this.
I
So thank you so
I'd
much.
like I'd like that too, Scott. Nice talking with you.
You're, you're very welcome. Appreciate you coming on. Again, I'm Scott Kidd, the Yacht Captain Investor Podcast. And just a reminder that the best investment you can make is the one that you make in yourself. So invest heavily in you. See you next time.